Welcome to this FCA Accountants Tuition Center YouTube channel. My name is Franklin Lwando, a lead tutor at FCA Accountants Tuition Center. I have vast experience in lecturing. I have been lecturing for quite a number of years, at least 20 years. Therefore, you are assured of quality content on this YouTube channel. In today's video, which will be the first series for the students taking courses in financial reporting and strategic business reporting. The focus is centered on IAS 23, that is borrowing costs. IAS 23, that is borrowing costs. IAS 23 is borrowing costs, which is the standard applicable for both financial reporting students and strategic business reporting students under a SCCA and under a Zika for CA 3.1. We shall be looking at number one, the borrowing costs. What are the borrowing costs? I'm giving the outline. What are the borrowing costs? To also look at what will be the qualifying assets. Qualifying assets. We'll also be looking at the calculation of interest to be capitalized. Calculation of interest to be capitalized. Number four, we'll also be looking at temporary funds that are not required now to be invested. So there will be a temporary investment of funds not required now. Investment of funds not required now. We'll also be looking at cessation of capitalization. And then we'll be looking at the journal entries. So in this first series of the videos, the focus will be on the outline. Borrowing costs. What are the borrowing costs? What are the qualifying assets? The calculation of interest to be capitalized. investment of funds not required now. When do we stop the capitalization of interest? And the journal entries for the interest capitalized. So basically, we'll be looking at those 5 items in this video. And then thereafter, we shall do a question which is at hand here. Therefore, we can get started. Borrowing costs refers to interest on loans borrowed to purchase or construct a qualifying asset. So number one, interest on loans borrowed for the purchase or construction of qualifying asset. Construction of qualifying asset. Also, we have finance lease charges. Finance lease charges are also part of the borrowing cost. Basically, those are the examples of borrowing costs. And now we are going to look at what is a qualifying asset, and then I'll explain how do we treat the borrowing costs. Qualifying assets are those assets that take a substantial period of time to get prepared and be ready for use or for sale. Examples could refer to 1, construction of power station. Number 2, construction of roads. Construction of ships. Construction of dams. So those are some of the examples of the qualifying asset because they take substantial period of time to be ready for use or for sale. Now I'm going to explain how do we treat the borrowing costs. So the borrowing costs, which are interest on loans, these are capitalized. To be capitalized simply means they are part of the asset. The borrowing costs are capitalized. Meaning they are part of the asset. Now, most students have challenges here. The journal entries here, or rather the double entry which we need is a debit the asset. And credit if the interest has been paid to be credit cash book or bank, or if it's not yet paid, credit interest payable. Credit interest payable. That will be the double entry. Now, I want to explain how do we calculate this interest. Interest is calculated for the period when there was activity to prepare the asset to be ready for use or sale. Any period that is more than 1 month, and in that period there was no activity, those periods should be excluded from the calculation of interest. Very important point. Only the period of activity should be considered in the calculation of interest to be capitalized. Very important. So now I also want to explain where we have the general pool of loans. The general pool of loans where there is a general pool of loans, these loans, they have different interests, and these should be used for various purchase or construction of qualifying assets. In such a case, the interest to use should be the weighted average capitalization rate. The interest to be used should be the weighted average capitalization rate. It's a very important point which I shall demonstrate when we start answering the question. Now, the other point to consider will be interest capitalization will cease once the project is completed. Capitalization of interest ceases capitalization of interest ceases. Capitalization of interest ceases on the completion of the asset. That is when the asset is ready for use. No more capitalization. The last part, interest that is not capitalized. Interest that is not capitalized because there was a period of non-activity. Interest not capitalized because of the period of non-activity. They should be, the accounting treatment should be a debit, the P&L, and credit, the cash. Or if it's not paid, interest payable. Very important. Now, where the company has borrowed specifically for the purchase or construction of a qualifying asset, and the whole loan is not required to be used at once. The amount of loan not required to be used now can be invested temporarily. Very important point. And in the question, it will be clear. So interest not required now. Sorry, funds not required now can be invested temporarily. Can be invested temporarily. And the interest income end. Very important. The interest income end. The interest income end can be used to reduce the interest to be capitalized. Funds not required now can be invested temporarily, and the interest income end can be used to reduce the interest to be capitalized. So now I also want to demonstrate what will be the journal entries or the double entry. So here we are earning the income. So we are going to debit cash if it is received. If it's not yet received, to be debit the receivable, interest receivable. And we are going to credit the asset account. Because it will reduce the interest to be capitalized. So that is the explanation. Now we are going to look at the question which is on the screen. We have that question there, Feed Limited has the following loans in place throughout the year ended 31st December 2008, which constitute the general borrowings for the period. So we have 10% loan, and that is 140, 8% bank loan, that is 200. Now, the first thing to do, since there's a general pool, you need to determine the weighted average capitalization rate. Is that okay now? So the weighted average capitalization rate, weighted average capitalization rate is calculated as follows. The first thing that you do is to find the total amounts of loans. So we have total loans to be 140 million plus 200. This will be 340. The weighted average capitalization rate will be 10% multiplied by 140 divided by 340, which is the total, plus 8% multiplied by 200 over 340. The formula here is very important. So we can calculate these figures. We have on the first one there, 140 divided by 340 multiply by 10%. We have 4.12% plus 200 divided by 340 multiply by 8%. We have 4.71. Total interest 4.12 plus 4.71, which will be 8.8 to the nearest one. So we have calculated the weighted average capitalization rate because we have the general pool. So now we go to the question there. On 1 July 20x8, 50 million was drawn down for the construction of the qualifying asset, which was completed during 20x9. What amount should be capitalized as borrowing costs at 31st December 20x8? That's supposed to be 20x8 in respect of the asset. So there was activity from the beginning. 1 July 20x8. So there was activity up to the reporting date, 31st December 2008. So there was activity for 6 months. Therefore, capitalization will be for six months. So there will be 8.8% multiplied by the amount drawn. That is 50 million. Multiplied by 6/12. So the amount to be capitalized will be 50 multiplied by 50. So the amount to be capitalized in this case will be 2.2 million. This will be part of the cost of the asset. So today, we have done this question and we have explained the concept. In the second series of this topic, we'll be looking at temporary funds to be invested, funds which are not required to be used immediately. We are going to demonstrate how that is done. It is very important to ensure that you look out for the notifications and be able to follow the concepts. We shall also look at a full-fledged question on borrowing costs. Therefore, ensure that you are on the lookout for the notifications. For today, we'll end here. Thank you very much for watching this video. God bless you.